Welcome to the weekly update, where I'll go over the action in the market for the week of November 18th through the 22nd, and we'll see how things look for the week of November 25th through the 29th. We're probably going to see volume really cut back this week. It's a holiday week. The market will be closed on Thursday for Thanksgiving. There'll be an abbreviated day on Friday. There might be a lot of folks who take the whole week off, so we could see volume really dropping off. But that doesn't mean that the market will necessarily be boring. We have a whole slew of information coming out on Wednesday, and the market will get a chance to react to that. Anything happens, either positive or negative, geopolitically, could have an impact on the market as well. In the week that we just finished, yeah, we're back to looking positive now on the daily charts. We're seeing some improvement after we've been getting some mixed signals for quite a while. We had that nice run up after the election. We fell back, but we stayed above the 20 period moving average. We never broke below that on a closing basis. And now we're starting to go back up. Now, it doesn't necessarily mean we're going to continue to go up, but right now, by looking at the charts, we still remain positive. So, just to go through a few things before I get into this, even though this is the weekly video, the daily videos are where I do my day in and day out analysis of what's going on. So, feel free to check those out. And they are available on YouTube and Rumble right after the market closes. There's a PDF below every video that I post in case you want to download this and look at the slides or the charts that I show. I update pivot points on the YouTube community tab every day, and some of those last for the whole month. And there are some pivot points that only last for that particular day. There is a private Facebook group that you're welcome to join, not really active. Seeing a few people coming into the group, but if you have any questions, if you have any feedback or anything and you want to contact me that way, feel free to do that. I go through and I watch YouTube and Rumble comments. They must have run some kind of webinar or something through Fiverr. I'm getting a few more comments on Rumble these days, and I just go through and delete them because they are these scammers that are trying to pretend being social media experts, and I just get rid of those. But if you have a legitimate comment, if you have some feedback, either positive or negative, that you want to give me, unless you're not being rude or totally out of line, no problem. I don't have any problem with that. I do post on YouTube and Rumble. So if you can't find me on one platform, feel free to go check out the other platform because every once in a while I will have problems uploading. Here's the link to the Rumble channel. And then I have a thing called the SPX Investing Program. For about another month or till the end of 2024, it is still free. And there are additional videos that I post there. There's trade ideas. There's also the ability for chat in that area. And I do a pre-market open. So there's a lot of things. And then I'll be rolling out once the program actually is more locked down. I have probably about 100 hours or more of courses that I'm revamping them now, and I'll be re-recording them. I'm kind of waiting because some of these, especially a technical analysis course that I have, it's pretty long, and I want to use as most, I want the charts to be as updated as possible so that when you go through this, you're looking at information that applies kind of to this time. And so I wait as long as possible to re-record, especially the technical analysis course. But there's a link that'll take you to the website or to a video. You can send me an email, and one of the benefits is that you get immediate access to the videos as they are prepared. And as I said earlier, the daily videos, the real foundation of the analysis that I do. There are a number of weekly videos, and then the supplemental videos, those are on an as-needed basis. I've been holding back on those a little bit lately. I'll be rolling out a lot more of those once I get the program going in 2025. Let's go back and talk about this week's session. We were up 1.68%, and volume was pretty healthy. We've been going back up, and we're seeing an increase in volume, and that's typically a good thing. We are positive when you look at all the charts, and we're turning back and looking much more positive now on the daily charts. And it's not as big of a concern right now about inflation, but the market doesn't worry about what's happening right now. They're looking off into the future. And a lot of these economic reports that are coming out are stronger than expected and not really showing a weaker economy. And so that's throwing this idea that the Fed's going to automatically cut rates again in December, that's putting doubts on that. Interest rates, they've been coming down a little bit, but it's like right when the Fed started cutting rates, the 10-year yield especially just started going up as the Fed rates were going down. And that could be because the market is anticipating economic growth. Also, now that the election has passed and things are more official, they're not officially official yet, but at least I think pretty much all of them all the races have been counted now. And so the market's a little bit more clear as to what's going to happen there. And then we're keeping an eye on geopolitical things. There's not only what's going on between Iran and Israel, which could escalate at any time, and we're watching oil for that to see how it might have an impact on the market. But there's been some changes in foreign policy between the US and Ukraine, and that could escalate things between Russia and Ukraine, or Russia and NATO, or even Russia and the US. So kind of keeping an eye on all of that. And then as far as our trend, we're not trending right now on the daily charts. We drop below 20 in the short and intermediate term. We're still trending here. We're still positive, but we're just about ready to cross over the moving average. And I'll show you that chart. So if that happens, and if the green line stays on top, this is longer term, and this could bode for things to be more positive going forward for the market. Okay, so for the week, just some bullet points here. Stock rose on this buy the dip trading mentality. Now, if you listen to any videos or courses that I teach, I'm not a buy the dip type person, because what is a dip? Is it 0.5%? Is it 2%? Do you go off a gut feeling and intuition? You'll lose. You'll win just enough to justify what you're doing, but in the long run, you could have 9 buy the dip successful trades, and then that 10th one could wipe out all your gains right there. I wait until the charts actually tell what's going on, but that's just where I'm at. Some people might actually be good at that kind of a thing, but it seemed like, especially this past week, anytime we saw weakness, like Nvidia came out with their earnings, they just saw a big sell-off after hours. Well, we went down, 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 not only with Nvidia, but with the S&P futures. And then they started buying, buying, buying. Now, Nvidia ended up not having a real strong day after their earnings had come out, but it had been down like 3, 4, 5%, and it ended up finishing up about 0.5%. And that's what you see in these kind of environments where any weakness, a lot of people out there teach, buy the dip, buy the dip. But again, what does that mean to in different situations? And what we're seeing now is the big stocks, the mega caps, like the Magnificent Seven stocks, the Great Eight, the Illustrious 11, they're doing okay, but they're not outperforming right now. And that's why the indexes aren't really breaking out. But on the other hand, we're seeing more broad participation within the S&P and across the entire market. And that is just suggesting that things are positive. We're seeing small caps and mid caps looking a lot stronger right now. They're not outperforming the large caps yet, but they are showing some signs of improvement there. And then Google and Target, they didn't have very good weeks. Target, they dropped like 20% in one day after their earnings came out. Google, if you know your history with computers and everything, about 20 years ago, they were after Microsoft for Internet Explorer, and they ended up really not changing anything, but at least on paper it looked different, where Microsoft was separated into 3 different parts of the company. Well, now they're threatening to take control of Chrome and possibly Android. They think Google might have too much influence in the market, and that's weighing on their stock right now. And then Walmart was up. They had an earnings report that was well received there. Nvidia ended up being flat on the week. I mean, they came out with just a really killer report, but people have been buying into this, and it's like, okay, after they report, I'm going to sell. And that's what a lot of people did. And then we did bounce up the day that the market was able to react to that. But by the time we finished on Friday, Nvidia really went nowhere for the week. And Bitcoin, it's just under that $100,000 level now. So a lot of folks are getting excited about that. And there are these geopolitical concerns between Russia and Ukraine, but so far there was some initial reaction. Most of it's happening more or less in Europe, and we're seeing Europe starting to underperform the US right now. But at some point that could bleed over into the US markets and really hasn't had much of an impact there. Interest rates were down on the week, not very much, but we ended up closing at 4.41% with the 10-year yield, where a week ago we were at 4.43%. And the economic reports that have been coming out have mostly been stronger than expected. But then on Friday, we got consumer sentiment where it actually went down. It's looking okay out into the future. It's people aren't feeling as good about things right now. Okay, so for the week, the Dow was up 2%, the Nasdaq was up 1.7%, the S&P was up 1.2%, and look at this. The small caps ended up being up 4.5%. And this is the chart that I've been showing for quite a while. We're still in this area in about 1976, maybe in the 1977, right in here where I'm circling with the laser pointer, where inflation is, for the most part, still coming down. Now, the reason I show this chart is look at what happened back in the 70s. Now, we don't know if it's going to play out this way or not, but just be aware of this, that things can change. And with this economic growth, with maybe interest rates not being lowered as much as they thought, there could be some inflation that comes back in. And if inflation starts to get out of control, we could see this blue line start to go back up and kind of match what happened before. We don't know how this is going to play out. And everybody has their own predictions about things, and that's fine. What we follow are the charts. And we're aware of this. We have a plan in place if things start to shift. But for right now, on an inflation basis, things are still looking positive. And then we are above that 4.02% with the 10-year yield. When it gets above that level, that's when it can start to bite into corporate profits. But you look at the charts for earnings going out into the future, and they're still going up. Maybe not as fast as they were before, but they are going up. And that justifies stock prices going up as well. This has not been updated. It won't be updated again until the beginning of December, showing how many people are unemployed longer term, longer than 6 months. And then this is part of the earnings justification with this red arrow. I put the red arrow on here, and everything is going up into the future. And that's why the market looks more positive, because looking down the road, earnings are still going up. And then bull markets last longer than you think. We're a little bit over 2 years into this bull market now. We bottomed in October of 2022. And so we're getting into the 25th month or so now. Well, the average is 67 months for bull markets. And there have been longer and there have been shorter ones. And you can go back and see when all these different things happen. And of course, the perma bears are just sure that the next big crash is just around the corner. That's actually positive for us, because that's what they always say. And they've been saying it for years now. And they finally felt somewhat vindicated back in 2022. Well, now the couple of perma bears that I follow, yeah, they're screaming that things are about ready to crash here. So, and use that as a contrarian indicator, because they've been wrong for decades. So, yeah, still looking pretty good that way. But it doesn't mean we'll always go straight up either. This is the 3-month flows on a rolling basis into equity ETFs and mutual funds. Now, this could be a little bit of a concern. You notice right at the end of 2021, we saw a lot of money going in. We're getting back up to the point where we're seeing a lot of money going in. Now, this could still go higher, and it doesn't necessarily mean we're going to top. It just means that there's a lot of money going into these things. And at some point, folks may run out of money to put into ETFs and mutual funds. And if there's no buyers, well, that's when stocks really start to slow down. Then we look over here at this chart where we have funds have trimmed exposure to the Magnificent Seven, and we're seeing that. Last summer, they were driving the whole market. If they were going up, the S&P and the NASDAQ 100 were going up. We're not seeing that as much now. And we have the Russell 3000 here. That's kind of like the S&P 500. It's up 28% when this was taken here. I'm sorry, this is the weight of the Magnificent Seven, where the large cap core mutual fund portfolio that has weighted at 21%. Hedge funds are down around 12% right now. Now, hedge funds, and I talk about them in the basic course that I have both on YouTube, Rumble, and then I have an updated version on the website. Hedge funds, they're kind of like mutual funds on steroids. They charge a lot more money and they're supposed to have rock star managers who do all this stuff. They might be big money, but they're not necessarily the smart money. So we like to know what they're doing, but we try to follow the smart money when we're keeping an eye on things here. And then trade policy uncertainty. Now, on one hand, this could be positive for the US, keeping all the other countries kind of guessing, where over the last few years, there was really no guessing. They either told the other countries what we were going to do, or they changed everything back around and it was more friendly to the other countries and less friendly to the US. Well, there's a new sheriff in town again for the second 4-year period. And so that's producing some uncertainty here and can produce some volatility in the market. And then we are seeing over time the amount of options volume just really going up right now. And I trade options. I'm very active in that. A lot of the strategies that I teach are involved with options, and I use them to hedge. So I use them for protection. I also use them for capital gains. There are some kind of riskier things that I do, and there's some very conservative things that I do with options that I teach in my program. And then this is the run. This is back to back 20% plus years for the first time this century. Okay, we're 24 years into the century, so it's kind of sounding, but we've had a couple of good years here. You throw all that money, that stimulus money into the market, inflation seems to be getting under control. For right now, over the last 4 years, they've really gone with this thing called modern monetary theory, which in the long term destroys every civilization where they've been trying it. But for right now, it seems to be working, and who knows? They always have this old adage, this time might be different. Well, we'll just have to see how that plays out. Then this is kind of interesting where we can see the correlation between, now this is not the NASDAQ, this is the NASDAQ 100, the QQQs. That's in black here. I think that's right. And then we have Bitcoin, which is in red. And you can see there's a pretty strong correlated relationship between the two. They get out of line with each other from time to time, but they're typically both going up or down at the same time. Then FactSet, we're kind of getting beyond the main part of earnings season. And this is kind of a disappointing post here. It says, what is driving the higher expected earnings growth for the S&P for the fourth quarter of 2024? They don't answer the question in the blog post. And so I read through the whole post that they have there, and they never did really answer that. But this is just looking at earnings growth. We have the projections out here for the fourth quarter, and they are going up, and that justifies stock prices going up too. All right, here's the intraday chart. Going back to Monday, where we had a nice little strong open here and then closed down a bit off there. We had a gap lower on Tuesday, but then we're able to come back in Tuesday's session flat. But then this is where we started to see some things changing back and looking more positive. You see here late in the day, each one of these bars is 10 minutes. And this is what I watch during the day. I don't day trade or anything like that, but you can get some insight by just watching an intraday chart. You see this move up that we saw going into the close on Wednesday. And that's when things started to shift and look more positive. Now on Thursday, man, we just gyrated all over the place. But again, we were able to break to the upside here. And then we didn't really do much in Friday's session. We went sideways, but it was still another up day. But a lot of times we'll get some clues as to what's happening by looking at the close of the previous day. And this is where we started to see some things improving here. So for the week, this is looking at the different indexes, and get this, the mid caps and the small caps had the best week. And if we're in an environment now where interest rates could be coming down and there's more economic growth, that benefits small caps and mid cap stocks. And that's what a lot of folks have been waiting for. Now, they're still not outperforming the large caps yet, but they are showing some signs of improvement, where for most of 2024, we've been seeing the S&P and the NASDAQ, with the NASDAQ 100 kind of going up and down. The areas that are underperforming right now, they were leading earlier in the year. So this is showing, at least for this past week, we're seeing a general shift over to broader areas of the market. And then looking back to the beginning of 2024, see where the NASDAQ, S&P, and NASDAQ 100, they were the strongest. We're seeing an improvement here with the mid caps. Small caps are still in last place year to date, but they're coming on strong as of late as well. And then the different sectors. We had an up week, so the sector that was up the most, materials, and that tends to benefit more from a stronger economy. Utilities are coming back after seeing some weakness. Energy's one of the weaker areas, but it's showing some improvement here. Real estate's been under a lot of pressure lately because interest rates have been going back up. Industrials, that's more driven by the economy. Staples are defensive. If these do really well and really start to outperform, that's when we get a little concerned. Discretionary, been doing well. This is Tesla. This is Amazon.com. Things that make life fun or things that you can choose to not have or have, or staples are things you have to have. And the tech was up, but not as strong. Communication was up, but not as strong. These are the big growth areas: discretionary, tech, and communication. They're doing good, but they're not outperforming the way we were seeing them earlier on. And the financial sector coming off of all-time highs. Now, healthcare has been under a lot of pressure lately, and this tends to be defensive too. Then on this chart, I rank them according to their scooter score. The closer to 100, the better looking that particular sector. And we have the financial sector, discretionary, in the 90s. Then we still have healthcare that's coming down. Now, energy had been doing really bad, but it's been showing some improvement. And if you want to see more interplay between these different sectors, there's 11 sectors that make up the S&P 500. Please check out the intermarket analysis video. All right, now here are the sectors showing that communication was down. That's a growth area, and we were virtually unchanged with discretionary. Where we're seeing things that are more cyclical, or they're more, if the economy's doing better, these areas tend to do better, at least these top two. Utilities can often be more defensive. We like tech going up. That's a growth area as well. And then going back to the beginning of the year, we have financials, which are now the strongest, followed by communication. And then technology is actually down. Now, this is measured. I don't base this around the S&P 500. I try to get more of a raw score when looking at these charts because there's other ways to evaluate this as well. Then we look at the relative rotation graph, and this goes over the last year. And we see where discretionary, it's green and going up. That's looking stronger. We have industrials, communication, and financials. These are stronger areas right now. Where real estate and utilities are still weaker, even though utilities had a pretty good week. And we see staples and healthcare. These are more defensive and they're weakening. So that's just suggesting that the economy is still looking pretty solid. We have been seeing energy coming back lately after it had been one of the weaker areas. Then this looks at it more like a spreadsheet showing the areas that were up: communication, industrials, financial, and discretionary. And that's pretty healthy for the market. Then areas that are showing some weakness, but they're more neutral right now: materials, real estate, utilities. The areas that are negative would be staples and healthcare, more defensive. And then some areas that are showing some improvement here in blue: tech and energy as well. Then we look at the major indexes. They're all jumbled right around the middle here. It's kind of hard to figure it out. Where earlier on, utilities were the strongest area, and you can see how they're really coming down. Transportation is looking better. We've been waiting for all of 2024 for them to improve. They're still not outperforming yet, but they are looking better. We have the mid caps looking better. The NASDAQ 100 is showing a little bit of improvement, but a lot of the large caps and even the small caps, they're potentially shifting from being more negative over to more positive if we see more follow through with the mid caps and small caps. So we have the Dow Jones Composite Average and the Utility Average. Those are showing some weakness now. And then the areas that are actually negative would be the S&P 100, and small caps. They're still negative on the year, even though they've been improving lately. The other areas that are looking better would be the mid caps, the NASDAQ 100, and the transports. All right, sentiment. Every week we get this survey put out by Investors Intelligence, and we're getting a little extreme here. It came in at 3.28. When we get above 3, that means that these folks that follow this survey, they're getting a little too happy, but this can still go higher than where it's at right now. And in really positive times, this can actually go up above 4. And we're starting to look more positive now when we look at the fear and greed index. This is what I follow every day. We were neutral a week ago, and we're actually starting to tip a little bit slightly negative with stocks going back up. Now this is starting to look more positive. And here is the historical chart here, where this is after the election when we really shot up and then we were pulling back. We got just about down to that 50 level, and lately we've been seeing an improvement. Now, what we do with this is if it's going up, we roll with that. If it's going down, we roll with that. It's when it gets above 75 or below 25, that's when we look at this being a contrarian indicator. But we're not there now. So we're tending to go with what sentiment is telling us, and that's more positive at the time, at least for right now. The active asset managers, for 2 weeks now, they've been above this red line. They're getting a little exuberant here, but they could still go higher than where they're at right now. They came in with their latest reading at 91.3. When we really get concerned is if they go above 100. And the VIX did see a decline here with the line chart and the bar chart. The VIX was really elevated right up until the election, and then we took off to the upside, and we've been seeing the VIX really coming down. And this is the seasonal tendency of the VIX, where from now until the end of the year, the VIX tends to fall, and that tends to be more positive for stocks. But we're getting a little extreme here with this sentiment gauge. We're getting a very high reading, and that means that according to this, folks are a little too positive on the market right now. We're still looking positive here. When the red line's going down, that means tech is outperforming cash. We're still getting, well, kind of a high reading here. We saw a little bit of a bump up. This is the bear bull ratio put up by Ridex. And they have mutual funds that go up in value when the market goes up, and other mutual funds that go up in value if the market goes down. We saw a little bit of an increase as folks were getting into the bearish funds, but this is as of Thursday. There's a 1-day business lag with this chart. We're still below the moving average here with the Ulcer Index, and we're dropping just about on the moving average now on the daily chart. This is a fear gauge too. When we get above the moving average, that's when we get concerned. We're still below here on the weekly and right on the moving average with the daily chart. And not seeing any real concerns here with the spread between risky and not as risky bonds. This is an inverted version here. We're getting very high readings here, which means there's not much risk. Now, you want to be careful. I showed a chart earlier on in the week suggesting this is as low as it's been as far as fear, meaning we're getting a very high reading here. Could this mean that we're getting to the end of this? Because this chart really can't go much higher than where it's already at right now. I mean, it could go higher, but when we get really extreme readings with this, we at least are open to the idea of it being a contrarian indicator. The latest reading from the American Association of Individual Investors saw a real drop-off. This is a week old, and they freaked out with everybody else as we had the week after the election that ended up being a down week. And then we look at the average of the VIX over 3 months and do a ratio of the VIX, and this is coming down, which tends to be more positive for stocks. We're also declining with the long-term equity put call ratio. That's positive for stocks. We're below the black line here with the National Financial Conditions Index, so that's looking good. The latest reading from GDP Now has us about two and a half maybe to the upside and about 1.5 to the downside. The latest reading is at about 2.5. Not great, but at least it's positive. And this is what it's looking like going forward. Now, we're going to get another reading on GDP on Wednesday. Here's another look at GDP. The takeaway from this is going forward, things are positive because if we have 2 negative quarters of GDP, that's a recession. This will also be updated at the beginning of December here, the real-time Somme Rule recession indicator. We're just still working off of this chart that's almost a month old now. Also, this chart is getting a little bit old, as is this chart right now. As far as inflation, not really changing all that much with the inflation now cast. And what's the Fed going to do in December? Not really sure at this point. A 52% chance that they're going to cut rates, a 47% chance that they'll leave rates the same. So we're seeing this kind of changing, where the market was a lot more convinced that they were going to cut rates, and that's dropping off as we're seeing an increase in the fact that they may end up leaving rates the same. And then looking out into the January 29th meeting, 51% think there'll be a 25 basis points after that meeting. And there's still 37% think that there won't be an increase or a decrease. And there's 11% thinking that will be 50 basis points or 0.5% lower when that meeting happens. And this is pretty much speculation at this point, how these change, because it's kind of far off into the future. This is the Fed balance sheet showing how it's gradually been decreasing here. And then we look at it on a year-over-year basis where it's still going up. And then we keep an eye on this. These are the overnight reverse repurchase agreements, not releasing anything crazy there. The financial sector is looking good for right now. The bank ETF is looking good for right now. If this chart really starts to go up or down, that's when we really take notice of this. Okay, looking at the advanced decline line based on price, we're coming in and setting a new all-time high based on price and volume. Can't get much more positive than that. We're seeing a real expansion of the new highs, not much of an expansion of the new lows, but we're still going down with the 4-week and we're going down with the 10-week. We're seeing some improvement here because this had really been faltering on the daily charts and even a little bit here in the weekly charts, but it's showing signs of an improvement. And you see a lot more green here than you do red, and that's positive too. The advanced decline ratio above zero, both with the 19-week and 39-week advanced decline ratio. And the accumulation distribution still is above an advancing moving average. That's longer term positive. We did cross back over the moving average on the daily chart. Now, the red line hasn't really started to go up yet, but the fact that we're above it is positive on the daily chart. As far as our trend, we're just possibly getting ready to cross above the moving average here. And that could be more long-term positive. I mean, look at when we had a crossover here. This was right at the end of 2023, and we just rode that baby up. And as long as the green line stays on top, and especially if it continues to go up, that could be more positive longer term. Now, there's no guarantees. I mean, we might see the red line cross above the green line. We've seen it crossing back and forth on the daily charts now. It crossed over negative. Well, this past week, it also then crossed back over positive, but we're not trending currently on the daily chart since the ADX is below 20. And the Erin indicator is still positive. We're above zero. And the mass index is not generating a signal right now. So looking at the daily chart, we came back up here, and I know it's hard to see with this big P right here, but I like to keep these pivot points in here, but I can't adjust where they're displayed. So we might be seeing some short-term overhead resistance right here at this pivot point. If we can close above that, that would be more positive. And then we're positive across the board with the Keller market model in the short, intermediate, and long term with the S&P, mid caps, small caps, and the triple Qs. We're negative with bonds based on price in the short and intermediate term, or we're positive with commodities now in the short term. The dollar is now positive across the board. And there's a number of reasons for that. The dollar's just been going up. It's still in a downtrend compared to other currencies, but it's really been just screaming to the upside right now because, okay, we got through the election and the system seemed to have integrity. Now, you may not have liked who won, but at least it appears that the system worked, and that's building confidence in the US. There's hope for that the economy is going to be looking better. And when those things all come together, that tends to boost a country's currency. And we're positive across the board here with the decision point scorecard. And we're coming up here in the trend channel, going back to 2009. We might be a little concerned if we get right up to the upper end of this trend channel. If we can break above that and close above it, that would, of course, be more positive. And here's also another weekly chart where we're still looking pretty good. You look at the longer term pattern that we see going back to 2023 of higher highs and higher highs and higher lows. There we go. Now we haven't set a new high yet here, but we're still looking fairly constructive. On a trending basis, we have the 50-week moving average. That's the red line, and prices above that. Looking solid there. Then we use the moving average crossover. Still looking good there with the S&P. We're above zero and going up with the McClellan oscillator. And we're still going down, but we're above zero with the summation index based on price and volume. The bullish percent index, we're switching back and looking more positive on the daily chart. We're looking more positive here on the weekly chart as well. We're above 50, so that means it's positive. But then we look at what's the direction. It had been falling. Now it's starting to go back up. And we're above zero with the Swenlin trading oscillator based on price and volume. Momentum is still kind of getting smacked around a little bit here. You could say we're still basically positive with the price momentum oscillator or PMO. We're just barely above zero based on price. We're still declining, but above zero based on volume and looking good here. And there's a lot of studies that are attached to the PMO, and we're going up with the PMOs that are rising. The buy signals are going up, and we're flat after, well, we've been looking a little bit weaker here with the PMOs that are above zero. If this could turn and go back up, naturally that would be more positive. We're not extreme right now with the percent B indicator. We're above the midpoint. That's positive there. The chicken money flow. We're finally starting to look more positive on the daily chart. After going sideways here for a while, we're still looking positive here on the weekly chart. And here is our shorter term oscillator. That's going up. With TSI still not really looking all that strong. Then we have three intermediate term trend oscillators. The MACD showing some improvement, the PMO and PPO. We're still looking okay here with the long-term oscillators, the Trix and KST. Here's the force index above zero in green. That's positive. We're ticking back up after we have been declining with the Chaikin oscillator. And we're still above 50 with the money flow. The RSI is still above 50. That's positive. We're going up above the midpoint with the Stoke RSI. The Williams percent R, now it's giving us an extreme reading here, but that could also suggest longer-term positive momentum. The rate of change, since we had an up week, we get a positive reading there, and we're well above this 20 level when we go back 50 weeks. That's suggesting longer-term positive momentum. We're still looking positive here with the ultimate oscillator. The vortex actually came down a little bit, but the green line is well above the red line, and we were getting a little extreme here with the green line. We'll have to see. It's turning more positive on the daily chart now. Now, this is another momentum oscillator, the Copic curve. It is still positive. And we're finally seeing a cross positive here that we've been waiting since about the early part of 2023. We were below this red line. Now we're finally starting to cross back above it. That could be long-term positive. And this is just different support levels that we haven't really come down to lately. So we are looking positive here with the Heiken Ashi weekly chart. We're pointing down, but positive since we're black with the Kegi chart. We're positive with the Renko chart, and we're positive with the three-line break. We're still negative with the three-line break on the daily chart, but all the other charts that measure trend are looking more positive now. We saw a real decline here with the ease of movement, but it's still above zero. And no new X's or O's were drawn on the point and figure chart. We're still working off of a triple top breakout that was generated on September 16th. And so we look at the long-term momentum as measured by the PPO. It's hanging on in the long term, seeing a little bit of an improvement in the intermediate term and some improvement in the short term. And this is kind of deceiving a little bit. This is short term, but it's still a weekly chart. And then I just use this for entertainment purposes. We did set a new cycle time here. It came in Halloween, but I don't put a lot of reliance on these kinds of cycles. We are going from neutral to positive with the Elder's Impulse system on the weekly chart. We're positive with the parabolic SAR chart. We're also positive on the daily chart. Here we have the S&P not quite back to an all-time high. We do have the mid caps hitting an all-time high and barely squeezing in a new all-time high with the small caps after Friday. The Dow is still looking quite positive. The NASDAQ also looking quite positive as well. The NASDAQ 100, even though it's underperforming, is still quite positive. Here's another chart of the QQQs where you can see it was up, but not up as much as some of the other indexes. The mid caps setting a new all-time high here. Small caps looking much better, but still underperforming longer term. This is a daily chart of the Wilshire, not quite back to an all-time high, at least yet. The NYSE, though, is setting a new all-time high. The FANG index coming in on the weekly chart, just really close to an all-time high, just a little bit off of that. The big software companies also looking better. All stocks, which looks at U.S. stocks and international stocks, still looking positive there. Believe it or not, ARK was actually up over 5%. And we're finally seeing a longer-term golden cross here. And my understanding is that ARK owns a lot of Tesla. So when Tesla does good, ARK does good. Looking at the bank index, looking really solid here. Maybe a little too solid longer term with the RSI getting extreme. But the momentum continues to be positive. And then we look at a seasonality chart going back to 2020, where we're up 80% of the time in November with a return of 5.8%. Looking at traditional Dow theory, just coming off of setting a recent all-time high, looking better here with the transports. Now, the utilities were dropping off, but they really came roaring back this week. So this chart is just showing more confirmation of strength for right now. Then we look at the commodities on a weekly chart here, still in a downtrend, but really bouncing back up. Oil, mainly watching that for geopolitical reasons. Not doing all that much. Spent most of the week below 70, and then we closed above 70 in Friday's session. This is the dollar just screaming up here. Haven't been this high since the whole COVID crash and then the fallout after that. So the dollar's been doing really well. Now we're still in a downtrend, but if this blue line crosses above the red line, that would generate a longer term uptrend. Copper, seeing some weakness here, falling back down here, but we're still in a longer term uptrend. But on the daily charts, we're starting to turn negative with copper. And that's a little bit of a concern because when the economy's looking stronger, then copper tends to do better. Gold just roaring back after a hit. It's seen some weakness. And silver still underneath its 13-week moving average. Looking at bonds based on price, we're still under the 13-week moving average, but showing some improvement there. Longer term, the stock to bond ratio, a monthly chart, still showing how stocks are outperforming. This was the decline in interest rates, and then the Fed cut rates, and then boom, interest rates have been going back up. And here's a weekly chart looking internationally. We still have US and UK rates that are the highest, German rates, which came down, that's in blue. And then the red line is Japan. Then some relative studies here. Where a week ago, stocks were taking over the lead on a year-to-date basis over gold. Well, now gold has come back and assumed first place. The black line are stocks. Then we have green is the dollar, red is oil. That's been bouncing up lately. But bonds are still negative based on price year-to-date. And we look at a ratio between the NASDAQ 100 and the S&P. Both are doing quite well, but the NASDAQ 100 has been underperforming. Growth to value, this is positive. Even though it's coming down now, longer term, this ratio continues to go up, and that's more positive for the market longer term. This is gold to the dollar, where it had been falling back down. Then the dollar's been going up as gold has been under some recent weakness. And then we look at another ratio between gold and stocks, where it really fell off. Now it's starting to recover, but still gold is in an uptrend with this ratio compared to stocks. And then bonds based on price continue to underperform stocks. Low volatility to S&P ratio. When this is going down, the market is more risk on, or when this goes up like it did in 2022, that means the market's usually going down. This is what folks get into when they're more defensive. If this can continue to go down, that would be more positive for the S&P. We look at a ratio between energy and tech. Even though energy is bouncing back up, it's still in a longer term downtrend compared to tech. Discretionary to staples, seeing a real breakout here. We're seeing a golden cross longer term. That's quite positive for the market. Then we look at the S&P 100, which lately has been underperforming the rest of the S&P, but longer term, it's outperforming. And then we look at another ratio between small caps and the tech sector, bouncing back up. But this is what I talk about, where small caps still have a long way to go before they start to really outperform. Yeah, they're improving here, but they've got to get all the way up here and see a golden cross here with this ratio. Then longer term, still looking okay here with the NYC Brett Thrust, the Zwag NYC Brett Thrust, still working off of some recent signals there. Longer term, going back to the 1987 crash, still looking good with the S&P. This is a further blow up of that same chart. We're still well above this support level. Now, one thing that happened recently is the Zohorchak method. We, for most of 2024, have been on a full-on buy signal, meaning that it was coming in at 10. Then we had some weakness last fall, and we came down to 8. And then after the election, we shot back up to 10. Well, when we were going flat a week ago, this dropped back down to 8. Now, it's not negative until we drop below 0, but we just want to keep an eye on this. It would be more positive longer term if this was eventually to work its way back up to 10. And then NASDAQ 100 weekly chart still well above this trend line going back to 2009. Still holding up well with the NASDAQ to Dow rate, NASDAQ 100 to Dow ratio. And the NASDAQ 100 to small caps coming down a little bit because small caps are starting to outperform. That's what we're going to be watching for on this chart. Then we look at the new highs, new lows, and take a 50-period moving average. This is a daily chart here. We're still above 0, but if we can continue to go up, that will be more positive for the broader market. We're also starting to go back up here when we look at the 50-period moving average just for the S&P 500, and we're well above 0, so that's positive there. Watching this 3-month yield, it has been coming down, but it's mainly due to the economy doing better. We're just watching this to see if it falls off a cliff, and we're also keeping an eye on the financial sector to see if that's still holding together. And right now it is. Then we look at a longer term chart of the cumulative new highs, new lows for the NASDAQ, which is starting to go back up. And then we had another Hindenburg moment. Now you listen to the perma bears and they've got this done, put a fork in it. The market is finished. But according to this, we have not seen a confirmation yet. And if you want to just pause this, this gives all the definition of the Hindenburg moment. I was very skeptical of this for a long time because the perma bears love this. And I mean, they're wrong 70% of the time because the market tends to go up 70% of the time. So why listen to these people? But they're just sure as anything that doom and gloom is right around the corner, even after we've gone up for decades now. But this just gives you more of an explanation. Now, what stockcharts.com does is they put all the criteria into this particular chart. We've seen the initial spike here. Now, what we need to see is another spike up between now and December 19th. That would be a confirmation. And the more spikes that we get, like we got right here, this is right before the COVID crash. This is right at the end of 2021. Now, these guys, the perma bears are like, oh, look at this. It's going to fall apart. It's going to fall apart. Well, we had other signals that were generated here and it didn't fall apart. Okay. So we're just waiting to see if that's going to turn into anything. Then seasonality, I've got a whole load of charts here. We're up 68% of the time with a return of 1.5%. Going back to 1964, this chart looks at November through April being up 7.1%, 77% of the time. This actually shows this during non-election years that the market does a little bit better than during presidential election years. But that's not what everybody thinks. They think, oh, it's election year. We're just magically going to go up. This shows longer term how the election years actually underperform, even though they're still positive. This is from 1984 to 2023, showing how all years together actually outperform just election years. This is another chart put out by Dan Bird, where we're in a time of real positive seasonality right now. We're finishing out November and then going into December. This looks at the monthly returns going back to 1950, where November is the strongest month. This looks internationally, where November is not the strongest month, but it's still very respectable. This looks at November and December, going back to 1928, where they tend to be positive seasonally. There's no guarantees with this. This is just what has historically happened. And then we have November to January, which tends to be positive. The whole fourth quarter tends to be positive, going back to 1950. We're through the first half of November. Now we're getting into the second half, where it tends to perform a little bit better than the first half, going back to 1950. Here's the Carson chart showing now going into the end of the year, we see a nice return during an election year. September and October were supposed to be the weaker times. That really didn't happen. Now we're seeing the stronger times in November and potentially December. And then looking at November, whether it's since 1950, going back to last 20 years, 10 years, or just during an election year, they're positive across the board. And then November is also good when you take November, December, and January are considered to be the best 3 months. And then looking back to 1950 again, where the S&P is up 11 out of 18 times, down 7 out of 18 times with an average return of 2%. Thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.